everyone. Today we'll have yet another interesting conversation with Mukul Pal, the founder and CEO of AlphaBlock. A few weeks ago, we talked about how AI can improve your financial wealth, and today we'll discuss more about the services that Alpha through Goldring is offering to the clients. Thank you again, Mukul, for being present today.
Thanks a lot, Andrea, for the time and the opportunity again to speak to you.
I want to start by asking you, who are the strategies developed by AlphaBlock specifically aimed at? What is the target market for the product, and what would you say is their need?
Index funds like Vanguard are for everyone, whether it's individual or institutional, investors. Passive investing is for everyone. And so our solutions, AlphaBlock solutions, are for everyone who wants to invest passively for the longer term, that is 12 months and above. And the target market is hence for the passive investors, which as you know is nearing or moving towards a $50 trillion mark. And today, there's an ETF, an index fund for most liquid markets, which include G30 economies. There is and will be an ETF for most asset classes like currencies, commodities, fixed income, and maybe soon even Bitcoin. So as you can see, the industry is building this huge passive instruments for almost everything, and passive industry is manufacturing all these long-term investing instruments at a great speed. And ETFs are today the most prominent mechanism to invest. So this is about the target audience and the need that we fulfill. The like I said, passive is the primary need, but more than that, the bigger need is that these products are very concentrated, and there is less accountability why people are paying even if small fees, and what are they buying and why are they buying, and the need is that people are really looking at a safe haven where they can not lose money or get what the market is delivering, and people who are kind of tired of trading and selecting and timing the market, who want to simplify their life, right? So this is a huge need, or the passive need, and people, there's always a trickling down effect from the active side to passive side, or vice versa. So this simplification is the primary need, and also there is need for performance. People want to get market performance as the last standing returns that the market has to offer, because people have mortgages. They want to not lose money. They want to simplify it. They are kind of distracted in many ways, and have intention that can I make more with less risk. So these are the kind of things which our products or passive solutions fulfill, and the target audience, and who this is really for.
Thank you. We know that AlphaBlock aims to provide clients an investment portfolio with open positions in the equities of major indices such as S&P 500 or S&P 100, but in a different proportion to the traditional allocation in that index. What is the advantage of investing in the AlphaBlock strategy compared to investing in a traditional ETF that's tracking a stock index?
Yeah, so maybe it's better to understand that what is that we are comparing with, because I think that will give a better idea about what is the really advantage that we have, right? And I think the one thing which is, and maybe these are things which people understand, but it's still essential to articulate for people who are new to investing or who want to invest passively. So an index fund is designed to replicate the index. And most of our listeners may not know this, but many times these ETFs that are tracking these indices do not do it perfectly. and they rather lose like 10 to 50 basis points, which is 0.1% to 0.5% every year on their assets. And you can call this loss a kind of tracking loss, a loss which is happening while you are tracking the index, while you want to be an index tracker, while you want to just do what the index is doing. Still, there is some slippage in terms of what these replicating indexes cause. And that kind of compound, you lose 0.1% to 0.5% every year, then it keeps adding up, and it's a loss, you know. And above these losses, the slippage losses or tracking loss, as I mentioned, there's also a management fee on these solutions, which vary from very low fee, 0.1%, in some cases even zero, to almost 11% every year. So there are a lot of range of fees that ETFs can charge. And above that, there is also an issue which we call the premium and discount issue, which means that if I go to buy an ETF, I may be paying a premium above the index that it is offering you to buy. Because ETF is basically about replication of an index. So if I go to buy that index, I may have to buy it a little expensive than what the index value is. And when I go and sell it, I may be selling at a discount. So this premiums and discount is also a cost, that adds up for the investors, and you can call it a mispricing cost, and if this is not enough, then there is execution costs, which are like brokerage costs. There are market making costs, because somebody has to make the market in these solutions, and so that the spread is less. There are other costs, right? So, and all these things are difficult for investors who's trying to simplify his investing. I'm trying to simplify my investing, my passive life, but I'm still paying money every year to do something which is supposed to be simple. So it's a distorted logic in terms of what passive industry is doing. It is a kind of expensive way to simplify investing, which doesn't make sense. And so this is gives you a context of what the industry is doing, and I'll tell you what we are doing. So AlphaBlock is giving the investors this alternative, a platform that makes all the costs go to zero in terms of execution, market making cost, and spread cost, discounts cost. All these things, including management fee, all these costs go to zero, most of them. And he can transform his slippages of replication that he's paying like 0.1 to 0.5% or 10 to 50 basis points every year. He can also convert that tracking loss to a tracking gain, and while reducing the risk in terms of we are not as concentrated. And we talked about it last time, how passive is really not passive, it is very concentrated. And this problem or this alternative has not been done for 50 years. So that's what innovation is about, and that's what our innovation is about, doing things that have not been done to not only make a better solution, but also offer it at without any hidden costs. I hope that makes sense.
It perfectly does, yes. So in order to help investors understand the strategy, can you describe the methodology and how frequently do you do the rebalancing?
Yeah, that's again a great question, and I think the best way to answer it again is to talk about what the industry is doing, and then to illustrate how we are different and how we are better. So the methodology of a passive process impacts billions of investors, or is designed for the economic man, right? Means if an economic man has saving and if he wants to invest, this passive is for them. So it's a really an impacting innovation which was designed to help the investor on the street. And such a methodology has to be open and easy to explain and very simple. And so the incumbent methodology is called MCAP weighting. MCAP is a acronym for market capitalization, which also means the size of the company. Like Apple is a $3 trillion company. It's the size of the company, and that also is the MCAP. So MCAP of Apple is $3 trillion. And the MCAP methodology, which builds the baskets which contain all these stocks, is a methodology to share the pie or build a basket where different weights are given to different components in a set of rules that everybody knows. And it's a really very easy process to calculate it. Any child from a school, the first grader, second grader can actually understand it in terms of what it is, what's happening. You can explain it to a child. So this methodology is about allocating weightage, and the incumbent method is weighting by size, which means that if Apple has $3 trillion and Amazon, say, for example, is $1 trillion, Amazon is a little bit more expensive and Apple is a little bit less expensive, but let's assume round it off to 3 trillion for Apple and $1 trillion for Amazon. Then, and say, let's say the basket has got only two stocks as a hypothetical example. And if you have to build a basket, then 75% of the weightage will be in Apple and 25% will be in Amazon. So you give more weightage to a $3 trillion company and less weightage to $1 trillion. You are actually dividing 3 by 4 in Apple weightage and 1 by 4 in Amazon. So this is how a market cap methodology works. And now, to give you another extend this example, if Apple continues to grow and becomes a $4 trillion company and Amazon remains where it is at $1 trillion, now the whole basket has become $5 trillion. But because Apple has become bigger, it will get more weight. So now Apple is 80% of the basket and Amazon is 20% of the basket. So as you can see that this incumbent method is about bigger the size, bigger the weight. Now, this is very simple, but however, it's also very problematic because you are giving so much weight to a certain company just because of the big size. And when something becomes very big and keeps growing, what happens? It creates a herding mechanism. People who are buying stocks, they forget everything and they only look at Apple. They think this is the greatest company of the world. And so they start moving away from diversification into buying these concentrated stocks, which make them even bigger. So it's a vicious cycle, which is triggered by a methodology which was written in 1871 and has refused to change. And this is the problem which creates more risk for passive investors. And this is why there is not one thing wrong with these incumbent methodologies, but there are many things wrong, because the first thing wrong is it is pandering on the human psychology and creating the big even bigger and creating a representation problem. Because if you think about it, the market is made of many companies, and many companies innovate and many companies grow, and there are many companies give jobs to people. But if only one company keeps becoming bigger and bigger because the index start giving it more and more weight, then it is kind of misrepresenting the market. It is not doing justice of telling the investors that there are these other 1,000 companies that are doing great innovation. It skews all the proportion to the few companies, right? So honestly speaking, this is a poor governance issue, and nobody is talking about it. We talk about ESG and we talk about saving the world, impacting society, social, but we don't talk about such intrinsic problems which are creating an imbalance in the society. Today's methodologies of building indexes which drive trillions of dollars and nearly 30 plus trillion dollars, and is creating a skew in the market, creating a risk in the market. And the biggest risk is that sometimes when the market falls or gets into a bear market and some of the big companies fall because of some negative news comes or something happens, and because quality is not about permanence, that it is always has to grow. They are so big, they are so large, and they have this whole gravity against them that they can fall. And when these big companies decide to fall, the market can remain in a bear market for long periods of time, periods of time, which means the recovery of the market will take long period of time, because the recovery is contingent on only these stocks. These stocks, if they are going up, market is in a bull market. If they go down, the market is in a bear market. None of the other things matter. And this is why if you see that these incumbent methods create a lot of risk, right? So where does we come in? Our methodologies are designed to reduce concentration, this specific concentration. It is designed to reduce risk. It is designed to diversify more. It is designed to be less weight obsessive, that is not increasing weight with every increase in price, every tick increase in price, but only rebalance weights or adjust the weight for a component in anywhere between 12 to 24 months. And when we do this, our methodologies are designed to outperform or do better than the index, because that's the innovation here. Not only to reduce concentration, but can be reduced concentration by reducing risk and increasing returns. And one might call it a miracle, but as Garfield Drew, one of the investors, said that simplicity is the most undermined investment technique. And sometimes we just, innovation is in front of our eyes and we don't see it, right? And so this monthly rebalancing that we talked about is a more of a feature which allows investors to go in and go out, but the overall weights, as I said, are only adjusted once in 12 to 24 months. So this is the incumbent method, the problems, and this is our method which resolves the poor design of the incumbent method and hence reduces risk and makes more return.
In terms of the minimum investment period, what do you consider to be the most appropriate for an investor with, let's say, an average risk tolerance?
Long-term investing has died because there is a lot of television and there's a lot of news, there's a lot of confidence, there's a lot of naivety in terms of knowing, understanding investment. People spend decades learning about investments, and the television or the news or Bloomberg just give people a false illusion that it can be done very easily. So the investing periods have shrunk, not only in terms of how investors hold the company, but also in terms of how long a company stays in the index, because companies are dying faster or they are becoming relevant. They're becoming irrelevant faster, right? So the ideal time for investors should be longer, should be more than 5 years, nearly 10 years, and even more. But that is not happening now. And I think that is what's going to happen in the future, because when you get into a boring and stagnating time, the excitement of trading, the excitement of selection, people have other problems in their life, so which kind of assists in investment horizons. And I think that's what is happening. And I think anything less than 5-10 years is not a relevant investing period. And when the shoe shine boy is not the hero of the story, then that is when that is when the Shushan Boy is the hero of the story. That's when there is a climax, and that's what triggers, I believe, a longer term horizon, because markets get boring and stagnant.
So you'd say more than 5 years, right?
Yeah, means
A minimum of 5
5 years.
years.
Yeah, I mean anything less than 5 years is not long term enough. It is, people should not be looking at their portfolio on a daily basis. They should not be using if they are especially passive, if they are trading, and if they have systems, and if they are doing active, they are not passive. And if they are passive, they should not be worrying about what's happening on a daily basis to their portfolio. They should think about it on a longer term basis, or they should let the money work for itself. It should compound. Compounding is not an exercise in investing that happens on a daily basis. It happens, but it's very small. If for money to really grow, you need to give it years. And to see a new methodology, you at least need to give it 2-3 years to see that, yes, did it do what it said it will do?
Okay, and speaking of performance, and keeping in mind that risks for investors have increased with the start of the war in Ukraine, also given the high inflation and interest rate hikes, and given that risk management is such an important element of your strategy, can you tell us how AlphaBlock's portfolios have evolved since 2022?
Sure. So for us, chaos is good, means in terms of not the wars and people dying, and wars generally um, are societal negative moods which are kind of negatively correlated to markets. If you see wars, they formulate bottoms rather than peaks. They happen at a time when markets are stagnating for quite some time. So this is the kind of other perspective to look at wars. But I think what I'm trying to say is that uncertain times are better for our methodology, because in the uncertain time, it's the big guys or the upheaval in the market. It really creates a different market environment where things are sideways or things are not just going up, and there's not just happiness all over. And that's the time really that the market cap methodologies or the incumbent methods are tested. And when they are tested, a new entrant like us has opportunity to show that we are better, because our recovery times are faster. If the markets crash or they fall, if we fall, everything falls to at the same time they converge. But this convergence is the time when you can see what's better, and that's what we do. So when markets are crashing or are sideways, we can show faster recovery time, which can be 2 times as fast as the market. So since 2022, many of our models are positive, and India is positive, and Canada is positive, and some of the other markets like Indonesia and global emerging markets are positive. US may be down, but it is down less than the market. So it's a mixed bag, but in almost all cases, we have done what we say we'll do, that is outperform um, while having less concentration. I hope I answered your question.
Yes, thank you. Now, going back to the fees, the strategies available through Goldring do not have a management fee, but there is a trading fee of minimum $0.5 with a maximum of 1% and a strategy entry fee of $200. Given the investment strategy, costs could be high, especially with monthly rebalancing. So, how is this rebalancing done? How frequently and how many positions are affected?
Yeah, so see, the technologies are catching up, and we are thankful to our early adopters, and I really want to utilize this opportunity to tell them that we are excited to have them as our visionaries to adopt this process. And I also want to tell them that our aspiration and our initiative and our intention is to soon get them to a zero fee environment where they are not paying any execution cost, and they are paying lesser and lesser, because we want to give them a world where they can see the performance or outperformance, and they can isolate that performance. And they cannot isolate that performance till the time there are some kind of cost. Of course, these costs are a percentage, and if the larger allocation is done, then these costs are insignificant. But when people try out on a smaller amount, the portfolio strategy, it can be it can eat into some of the profitability that we are trying to illustrate and trying to show, right? So what I can say is that these are early days, but soon we are working on giving a zero fee environment so that the brokerage costs are zero. And also, I think that if investors really want to really get the benefit of it, they have to put some material money so that the percentage cost of maintaining these products, which are more infrastructural rather than a feature of AlphaBlock, and that's when they can really see that how the process works. Regarding rebalancing, as I said, that rebalancing is a portfolio construction designed for investability, which means we want to allow investors to come in a month if they want to increase it on a monthly basis, more assets so that they can passively stay invested. But from an average holding period, the average holding period, as I mentioned, is 12 to 24 months. So it's very, very less touched strategy, and positions are affected. So the turnover is really very less in terms of 3 to 4% a year is a real turnover. It's a very slow strategy which churns less. So even if there are initial execution costs, these costs are not are not there as the maintenance of the portfolio is there. So so that's how it works. I hope I was able to answer your question.
Yes, thank you. Now, before we end our conversation, please tell me and our listeners, what do you see to be the future trends or challenges in the investment world, and how do you think AlphaBlock strategies can respond to these challenges?
Yeah, so I think that the world is becoming trickier, and means I think we have lived through a huge time of prosperity, and I think that if the world is not seen as a global, if we don't see it as a global investment world, it will become harder to conserve capital, and it will become harder to generate wealth. Not only in terms of world being, being a global village, but also in terms of assets, different assets. People have to get to a stage where they have to diversify between portfolios, and that's the trend that's happening. Of course, you are aware of the inflation trend. You're aware of how volatile the things are becoming. And I think while the things are becoming inflationary and volatile and challenging environments, there's also a need for liquidity. So the world is moving towards liquidity. They don't want to get stuck into an asset class where they have no recourse to to their money, right? So, and all the crisis and the scams and the frauds only push people to quality. So there is a push, there is a nudge, there's a huge rush towards quality. There's a rush towards more liquid instruments. There is a rush towards how can you get more wealth or more returns or in more excess returns at a lower cost. So these are the technological trends that are happening, and that is going to shape our industry, and which means that how passive investing is looking today will not be the way it will look tomorrow. Passive investing has to do more, and it will have to do more if it has to survive, because people are not just going to say I'm going to pay no money and say, thank you very much for charging me 20 basis point or 200 basis point annually for doing nothing, which is replication and which is concentrated and risky. So investor education is also rising trend, and which is what AlphaBlock believes it's rightly placed to benefit in this new revolution of a smarter investing, smarter passive investing.
Thank you so much, Mukul, for the interesting information you shared with us.
Thank you, Andrea, for a great opportunity to speak to you again and speak to investors. I'm really excited about sharing this information and getting feedback from our investors and our friends at Goldring.
Thank you so much. And for our listeners, don't forget to check Goldring's website and find out which discretionary strategy fits you best. Until next time, make thoughtful investments.